Welcome back. The sharply higher than expected inflation number in India in January, now buttressed by a slightly higher than expected inflation number in the US, seems to indicate all-round higher rates, tighter financial conditions. The first casualties in India have been the real estate stocks, which fell sharply yesterday and remained downbeat today. Joining me to discuss the rate scenario and its impact on demand, especially on real estate, are Samiran Chakraborty, Chief Economist, India at Citi, Girish Kousgi, Managing Director, CEO, PNB Housing Finance, and Sandeep Runwal, the Managing Director of Runwal Housing. Gentlemen, thank you very much indeed for joining me. Samiran, if you can lay out the macro environment now. I just saw your report. You are expecting one more rate hike. Is it just that, or can cost of capital get even tighter?
Good morning, Lata. I think what we are dealing with is a situation where inflation is turning out to be quite sticky, and the sources of inflation are also constantly varying. So sometimes it's due to supply side factors, but sometimes there is an element of demand side also into inflation. That makes the policymakers' job extremely difficult. RBI has a medium-term target of 4% inflation, but inflation has been outside that target for far too long. The MPC is indicating that more calibrated action is required. And on that basis, we have called for another 25 basis point hike in the April policy. But we have also explicitly stated that if RBI's growth forecasts are correct, which is at 6.4% for next year, then the demand side impetus is going to stay for longer, which might require even more rate hikes beyond the April 1. But given that we have 2 months of extremely good base effects coming in March and April of 100 and 140 basis points each, optically the headline numbers might come off, giving RBI MPC some time to ponder over the global developments and local developments before deciding whether more rate hikes will be needed.
Okay, fair enough. I mean, at the moment, 7% looks definitely daunting, but from 6.5%, we go to 6.75%. That is fast emerging as the consensus view. But Samiran, can cost of money get even more high or more expensive for corporates and consumers, simply because financial conditions are tightening anyways, all-round tightening, even global financial conditions are tightening. So will the impact on corporates and consumers be more than just 0.25% more?
So it's actually quite interesting that everywhere globally central bankers are quite frustrated that the financial conditions have actually not tightened enough for it to quickly reduce inflation. In India also, the durable liquidity in the system is very much in surplus at more than 2 trillion rupees. And over the next couple of months, this durable liquidity is probably going to go out of the system. That can push rates higher a little bit. But we have to keep in mind that even with all these rate hikes, we are barely coming back to where we were pre-COVID. And that's why RBI is still calling its policy an accommodative one. We have not yet moved into restrictive territory. So in some sense, we would be very lucky if we are able to contain inflation without being forced to go into a restrictive monetary policy. I think that will be in some sense a Goldilocks outcome.
Okay, one hopes. Girish Kousgi, what is the impact you are seeing already on home loan rates, EMIs and demand?
Hi, Lata, good morning. So I think it was expected after the repo increase. I think in last few quarters, there has been quite a bit of increase. So whenever the rate increases, there has been some kind of dampener in the demand that is more contextual and short-term in nature. So if you look at the last repo increase, not the recent one, so we saw that November was good. December, if you look across the industry, most of the companies, they did less in terms of disbursement. And therefore, if you look at quarter three, even though on a YOY, they showed good growth, sequentially, there was a bit of dip. Now, this repo increase also would mean that, for some time, maybe 2 weeks, 3 weeks, maybe a month's time, the demand would optically look lower because people would go on a wait and watch, a state of mind, and then probably take a call. Yes, in terms of demand, medium term, even short term, medium term, long term, demand is intact. We can see some kind of demand after the next few weeks, but I think it'll come back. So I think
Girish,
that's the
Girish, 1 minute. Girish, 1 minute. Let me just nuance the question more. Do you expect home loan rates to go more than 0.25% higher? Similar to the question I asked Samiran, because it is not just the repo rate which is rising. Even market rates, the ability to find money could be a little tighter because people who are borrowing abroad are now borrowing here. Our 17% credit growth is largely because others are coming here. So are home loans likely to get even more expensive than just 0.25% more?
I think if the question is, will there be increase in repo rate, the answer is yes. What extent? Maybe
No,
25%.
not repo rate. That is not what I asked you. That is what I asked Samiran. I'm asking you if home loan rates, yes.
I'm coming to it. So what I am saying is that in last few quarters, whenever there has been a repo increase, I think that has been passed on to the customers, and also both old as well as new. Now, the recent repo increase, not many of the institutions have actually passed on because the rates have actually gone up. So in that extent, you will see that most of the HFCs and NBFCs probably may not increase because they're pretty comfortable on the yield. So increase in repo need not necessarily mean that increase in the home loan rates. Maybe it might be no increase, or it might be maybe some of the increase might be passed on. I think that's the answer for that question.
Okay, a lot of banks have definitely pushed up because they are tied to the repo rate. But Sandeep, Runwal, good morning. What do you sense is the impact already on the ground? Because we only have some Mumbai property registration numbers, and that is down 7% month on month. My colleague Sonal tells me that January is usually lower than December, but it is usually 4% lower. This time it is 7% lower than December. Is there an impact?
Morning, Lata. I think the real estate had an extremely good run in the last year and after the COVID. And right now we are seeing it coming back to the pre-COVID levels. It's moderating. We will definitely, the demand will continue to be very, very strong for real estate, at least for the next 6 months. We are seeing a lot of walk-ins. The conversion ratio has definitely dropped across all sites. What used to be a conversion ratio between 8 to 10% of all walk-ins has now started to slow down between 5 and 6%. Although the number of walk-ins have not dropped. Maybe one of the reasons could be people are still trying to figure out their budgets. They're trying to figure out affordability, and they're trying to see if there is any change in the market pricing for real estate.
For the real estate companies itself, Sandeep, can this be a double whammy that when you go to borrow to build the house, you pay more, and your demand could be incrementally lower because people are faced with higher interest costs?
So I think in terms of borrowing costs for good quality of developers, it is still within a range which is quite affordable. And it is, I think most of us have had a good sales velocity for the last 12 to 18 months. So the liquidity position with most of the larger developers is fairly good. I do not see that changing the next 3 to 6 months at all. In terms of price changes or in terms of drop of demand also, you would see a little bit of change in demand in the most affordable segment, which is the most price sensitive market. But the demand between a 1 crore to a 5 crore product is still very, very strong. And we see that not changing right now.
Oh, okay, that's important. Samiran, can you broadly assess the impact of rates already taken on demand, real estate and otherwise? I mean, if you go by the assessment of companies that have reported in Q3.
So Lata, if I look at my activity heat map of high frequency growth indicators, it is showing a very modest slowdown, but it's still more of green than red. So I would say that because the rates are still in that accommodative zone, the impact on economic activity has been not that strong. In fact, what I worry more than the rate hikes is the fact that the excess savings built during the pandemic by consumers, that excess savings is getting spent out. And once we reach a critical point on spending out of that excess savings, then that can start affecting consumption demand. There are some early signs of that in some of the consumer durable segments, which could be also of a reason or caused by a switch towards more services spending by the consumer. So, in a broad sense, I think in an aggregate, consumer spending has not dropped as much. There's been a consumption shift from goods towards services. Interest rates have not played a big role, but falling excess savings and its impact on consumption has to be very closely watched.
Would you worry about consumption, both real estate and otherwise, in the year to come, Samiran?
Yes, I mean, we have highlighted that fall in urban discretionary consumption is one of our biggest growth risks for next year. While there are some very early encouraging signs on the rural demand front, where after a very long time, the rural agricultural wage growth has crossed 7%. The momentum in this wage growth number is also quite strong, almost closer to double digits. If that trend continues and if the Rabi crop is also good, then maybe rural demand to some extent can substitute for the fall in urban consumption that we are penciling in.
Okay, that's very good to hear. Girish, what is your sense about credit growth, home loan growth in the coming year?
Okay, in terms of growth, as I mentioned, short term, of course, there will be an impact, but the impact will be more felt, on the affordable side, because up to 30 lakhs, I think the demand could be quite low because of rate increase multiple times. But even though it is short term, it might impact to a certain extent, maybe another 1 quarter, because it is more sentimental rather than the actual impact. Because 25 bips, 50 bips increase is something which is already taken into account, budgeted. So at an industrial level, I don't see there'll be a huge drop in the growth rates, what was envisaged.
Okay. Sandeep, final question to you. There is another problem for real estate companies in the sense that that 10 crore capital gains expense has been capped at 10 crore if you buy a house. That will start working its way from April 1. Do you expect demand to be less than it was in FY23 in FY24?
So Lata, I think the finance minister has been very, very clear. She's been trying to remove all sorts of tax breaks which have been available to the industry, various industries. And in line with that, she has also done the same thing for the real estate industry. Also, a very small segment of the market is actually high-end luxury. And out of that, also, a lot of developers would have only 1 or 2 projects which are in the high-end luxury market. I personally do not see the market getting really impacted too much by this kind of a move by the finance minister. Okay. It will see maybe an immediate drop in the next 3 to 6 months, but after that, the market will definitely stabilize. We will also see a similar growth in the next 2 months in terms of sales, because all those who are looking at buying will definitely prepone their decision. So you will see a push for luxury in the next 2 months for sure. And, coming back to the
more secular, the more medium-term impact of rates.
Correct. So the medium-term impact of rates on high-end luxury is definitely not going to be much, because it really doesn't impact that buyer at all. He is more like a capital gain market or his own self-funding. So you would continue to see high-end luxury to be strong, mid-market to be strong. It's, I think, the lower end and the affordable, which is really going to be a little worrying for the next 6 months.
Okay. All right. I guess that's what the stock markets were expressing when the stocks went into the red in the past 2 days. Thank you very much, Sandeep, Runwal, Girish Kousgi and Samiran Chakraborty, for giving us an idea of what the rate hikes can mean to the real estate market. Wrap up on Bazaar. Chartbusters up next.